two stocks that have absolutely gone to the moon over the last several days are the classics AMC and GameStop. But guess what? Keith Gill, aka Roaring Kitty, has posted numerous pics and clips on Twitter, which showed that he's returned after a 3-year-long hiatus.
Rod, Jerry Maguire, how you doing?
Jerry Maguire!
Yeah,
How am I doing? I'll tell you how I'm doing. I'm sweating, dude.
Now, 3 things that this video will cover. Why are the stocks going up? How is this happening? It's a thing called a short squeeze. And then number 3, what should you do? Why are the stocks going up? So stocks can go up for a whole host of reasons, but the top 3 are as follows. Number 1, the one that we want to see, they're growing in size, they're growing in value, they're selling more products and services, they're generating more revenues, they're reducing costs, and they're growing cash flows. Remember, that is where value comes from at the end of the day, is cash flow. Number 2, supply and demand. If there's very low trading volume on a stock and there's more buyers than sellers, demand is going to outpace supply. The stock is going to rise until equilibrium is achieved and supply equals demand. Number 3, our current scenario, it's called a short squeeze. Now, this is a derivative of number 2, supply and demand. When short sellers have to cover their position, they do so via a market order. A market order is time sensitive, not price sensitive. So it means buy the stock right now. It doesn't matter what the price is. Now, because they're forced, they being the short sellers, to buy back the stock right now, they're going to buy in a very short time frame, and it's going to be a whole bunch of them at a given time. So what's going to happen is demand is significantly going to outpace supply. The stock is going to rise quickly, potentially in large increments. Think about it. If you're holding that stock and the stock is just ripping, what are you going to do? Sell? You're probably going to say like, hey, how long is this party going to last? I'll just hold it and hold it and hold it. And that causes the stock price to go up even higher, even faster. Now, how is this happening? So going back to the previous point, looking at AMC and GameStop specifically, they're not increasing revenues or cash flows. They're not increasing value. If you go through their recent financial results, both companies are losing money. Their revenues are declining. Their costs are increasing. Their margins are compressing. For all intents and purposes, these are dumpster fires. These are not long-term holds. If you did do that, a long-term hold for either one of these stocks, you would end up having 0 in the future. Now, when someone sells short, they borrow the shares from someone else with the idea that they're going to replace them later. Now, in order to do this, they're going to have to put up what's called margin. The Federal Reserve, through Regulation T, requires that 150% of the value of the short sale needs to be in the account at the time the sale is initiated. So let's go through a simple example to understand this. If I sell 100 shares short of GameStop at $50, that means I have $5,000. Now remember, I need 50% of that value sitting in my account in cash or $2,500. Technically, this is considered my investment. Now, if the stock goes down to $40 per share, I buy the 100 shares at $40 per share and replace them. What that means is I made $5,000, I spent $4,000, so my net is positive $1,000 on the original $2,500, which is a 40% return. Now, if I did that in 1 month, my annualized return is 40% times 12 or 480%. Not bad. Now, the current margin requirement being 50%, I need to have 50% of that original position sitting in my account or that 2,500. So what happens if the stock goes from 50 to 60? Now we have a problem. So remember that 150% requirement, the stock is now at 6,000 of total value, 100 times 60. So if I want to hold that position, I need 150% value in my account. So we had the original 5,000 when I sold it initially and the 2,500. So I'm short $1,500. So I have one of 2 options. 1, I input $1,500 into my account, or 2, I go out in the market and I buy those shares. So again, if I decide to keep my position, I'm going to have to put up that $1,500. Or if I want to close the position, I need to go out into the market and buy the 100 shares at $60, which is going to cost me $6,000. So remember, I made $5,000 originally. I spent $6,000, which means my net is $1,000 negative. That was on the original 2,500, which is a negative 40% return. Now, let's not forget, during a short squeeze, many short sellers are having to buy the shares to cover their positions at the same time. It's basically like everybody's running for the exits during a fire.
Oh my God! Okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm!
Because the stock is going up, there's not many people who want to sell. Who wants to sell a stock that's going up? You want to hold that stock and just continue to party as it goes higher and higher. Now, remember, that's because demand is outpacing supply. And when this happens, we can see significant increases in the stock price in a very, very short compressed period of time. Now, prior to the run-up, last week, the stock was trading in the $10 to $12 range. So let's say last week, I sold the stock short at $10. If I sold 100 shares at $10, that means I have $1,000. But remember, I need to maintain that margin of 50%. That means I need to have $500 in my account, which is considered my investment. Now, in order to close my position, when the stock rips up to 60, I would need to go out to the market, buy 100 shares at $60, which is $6,000. So remember, I made $1,000 originally, then I spent $6,000, which means my net is minus $5,000. And remember, my original investment was $500. That's a negative 1,000% return, or I lost 10x my original investment. So number 3, what should you do? Honestly, this is gambling. There's no other way to describe it. I would not call this trading. I would definitely not call this investing. This is essentially gambling. GameStop is highly overvalued at $50 to $60 per share. There's only one analyst on Wall Street covering the stock, and they have a value of $5.60 a share. Now, normally, I would build a financial model on GameStop. I would project out the future cash flows, derive a fair or intrinsic value for the company, but guess what? I can't even do that with them. Why? Because they have negative cash flow. The company is declining in value. So I literally can't even build my normal financial model on this company. Now, a strategy that could work is betting that the company will return to its original value that it was at last week, that $10 to $12 range. This can be done through long-dated put options, the right but not the obligation to sell a stock at a particular strike price, and this is exactly what I did. I bought 2 options with a strike of 50 that expire in January of 2025. So that means I have 8 months until it has to get to that equilibrium value of 10 to 12 bucks. They cost me 25. Let's say it goes back to that equilibrium of 10, which means I can sell for 50 something that is currently 10. That is worth 40, because if I could sell something for 50 that's currently at 10, that's a difference of 40. So I would make 40 on something that cost me 25. That's a gain of 15 over 25. That's a 60% return. That is something that I'm willing to do, and I'm going to ride out the storm and not worry about the short-term insanity. You should always seek the advice of a financial professional. I do not know your financial situation. I don't know who you are. So if you were to do anything, I wouldn't consider a long position. It's effectively gambling. You're basically playing a game of musical chairs where you could lose all your money. Not something that I would recommend. Now, if you do consider doing anything with this, long-dated put options, like I had mentioned, would probably be the best way of going about it. But be prepared for a bumpy ride in the short term and a ton of volatility if you even choose to do that. Now, you would be much better served investing in high quality stocks. So fortunately, I did a video overviewing the Mag 7 tech stocks, which I highly recommend you check out. I've analyzed all of them, built financial models for them. And if you like this video, please share it with someone who you think would find this helpful. And as always, be relentless.